Hello, I'm Peter Herbert from Insight Training. Welcome to today's short session, one of the series we're running at the current time, dealing with accounting, auditing and company law issues, particularly pertinent in the current climate. Today's session is going to look at COVID-19 and charity accounting. Here's the programme for the session today. So we'll start off by looking at going concern, we'll look at income accounting, one or two other accounting frequently asked questions, and finally some guidance for independent examiners. Let's begin with going concern. FRS 102 states that an entity is a going concern unless manager either intends to liquidate the entity or cease trading, or has no realistic alternative but to do so. The charity sector has been really adversely affected by COVID in a number of respects, and it could well be that some entities are not going concerns as a result of what we currently are. But that's a very, very extreme situation, and it's not likely that most organisations will be anything other than going concerns. What I want to do therefore, I could just remind you of the four possible outcomes here and how that then links in to where we are with charities. So as I mentioned, unlikely but possible that an entity would be a non-going concern, in which case what FRS 102 would state is you would use an alternative basis for accounts preparation. Not going to get into that today. Second situation, which I think is probably more likely for more charities, is where there's material uncertainty that casts significant doubt on going concern, and there would be disclosure implications there for the trustees report and for the notes to the accounts. Per FRS 102, where there's some uncertainty but not material uncertainty regarding going concern, there's no particular disclosure requirements, but the financial reporting's guidance for company directors on going concern, dating way back to April 16, stated, if there's some uncertainty but not material uncertainty, don't be afraid to over-disclose to put the reader of the accounts clearly in the picture. And the recent guidance issued by the Charity SORT Committee for the sector has aligned with the FRC view dating back to April 16. Now for non-charities, where there's no uncertainty regarding going concern, there's no disclosure requirements. That's not the case in this sector, where there'll be some disclosure around going concern in every single set of accounts that you prepare. And in that sense, the SORT is more onerous than FRS 102. Let's remind ourselves of how it works for charities then. So there are kind of four things to bear in mind. In relation to trustees report, where there is a material uncertainty that casts significant doubt on going concern, that needs to be explained in the trustees report, as well as in the accounts. That's the second thing. Where there is no material uncertainty regarding going concern, what the SORP says is you need a statement in the accounts to that effect, that there are none. And I think what's also quite interesting at the current time is thinking about reserves policies. Maybe in the light of where we currently are, it's a good time for possibly charities to review and think afresh about their reserves policies. And maybe in explaining reserves policies in annual accounts, in the trustees reports, refer to COVID in that explanation and really explain how it's impacting on what the policy actually is. So food for thought there, I think, in the current climate about the framing really of those reserves policies. Just in terms of, I suppose, broader issues, very pertinent to the charity sector, I want to mention these two things to you. So what charities need to do when they're in real financial distress is make a serious incident report in England and Wales to the Charity Commission. I wanted just to flag, if I could, that updated guidance was published by the Charity Commission in June 2020 with a table of scenarios explaining which would trigger a need to make a serious incident report to the Commission and which wouldn't. So I think whether you're working within a charity or you're advising charities, that guidance on the Charity Commission website is well worth having a look at. And secondly, and again, obviously very specific to this particular sector, where an examiner or auditor has issued what I'm going to call a non-clean report, and that would include, for example, where maybe an examiner's report or an audit report reference has been made to a material uncertainty that casts significant doubt on going concern, then a regulatory report would be required, a report of a matter of material significance. So quite important implications for auditors and examiners there in the event that they are making reference to a material uncertainty in their report. One question we got recently on a course, this is from an auditor actually, which I thought I'd just share with you. Although we're satisfied that there is no going concern issue with a charity, our policy as auditors is to still insert an additional paragraph in the going concern section of our report to highlight the inherent uncertainty of the current situation. Would this require a report to the Commission? The sense I got on the feedback I got when the Charity Commission last looked at whether they were receiving reports from examiners and auditors when they ought to have been, going back to I think late 2017, is they'll do a text search looking at paragraph headings in reports as a trigger for should we have got a report from the auditor, from the examiner in that particular context. Therefore, what I would say with this one is, so I'm not absolutely confirming this, but giving my view, is that where you maybe have changed the paragraph heading in your report to allude to a going concern issue, then I think that would, in the Commission's mind, trigger a need for a report to them. If you've embedded additional wording without changing the paragraph heading, I think less so. Okay, let's move on to income accounting and some common questions here. Now, quite a few of the questions we've had here have come off the back of raising the issue of how do you actually account in a charity's books for coronavirus job retention scheme grants. And the first question, I suppose, which kicks off the discussion here is this one. The charity's got furloughed employees and is receiving CJRS grant as a result. Is this restricted or unrestricted income? I think my take on that one is it's very much unrestricted for a couple of reasons, really. First of all, in relation to CJRS grants, in order to qualify, staff already need to have been furloughed. So they've already done what they need to do to qualify. When we think about restricted funds, it's all about donors giving money to a charity with a view to them using that money for the purpose actually in the donor's mind. If you've already done what you need to do, the sense really I got is that the whole restricted funds aspect doesn't really come into play. Furthermore, I think when it comes to restricted funds, it's all about donors giving money for a very particular charitable purpose. And I think in the context of the government making CJRS grant payments, there's not a particular charitable purpose in mind there. And therefore, I would say, to my mind, from that reason as well, this would be unrestricted income. Does that mean that any grant received to cover wage costs should be treated as unrestricted? Well, not necessarily. I think when it comes to restricted funds generally, what you've got to ask yourself is, does the donor want a donation to benefit a charity in a particular way? And it may well be in some situations where donors do provide funding to cover wage costs, they want that particular money to be used in a particular way in the charity, and that therefore would be restricted. It could be in other situations that perhaps money is provided to cover wage costs with no particular intent in the mind of the donor about how that money will be used. And in that situation, it would be unrestricted. So I wouldn't say for a minute that we would say that any grant to cover wage costs would always be unrestricted, but I think my view certainly in terms of the CJRS grant payments is I think it would. A final really good question that cropped up on a recent course was, what if the furloughed staff were working on specific charity projects, which are therefore maybe funded by restricted funds, or sort of very much in the restricted funds sort of area? And I think in that situation, yeah, I would say if you've got maybe people working on a very specific activity where money's been provided and that's very much within a particular restricted fund area, it would certainly make sense to me to have the furlough payments there in that situation reflected within that particular fund. So yes, I would say probably what would make sense there is bring the furlough grant into unrestricted income and then transfer across when people are working on very particular projects which are within an area of restricted activity. That's probably a logical way to go in that eventuality. So 3 questions, we're getting quite a lot there, all to do really with the presentation and the treatment of the CJRS grant within charity accounts. Okay, let's then have a look at some other frequently asked questions in relation to accounting at the current time. First one, charity A has breached loan covenants for the first time. What are the accounting implications? Well, clearly if you breach loan covenants, there's going to be implications there for going concern, as mentioned a little bit earlier on. Then the other thing to bear in mind, if you're in a situation whereby as an entity, charity or otherwise, and you're in breach of loan covenants at the year end, that may well mean that the loan you've got that might be a long-term loan becomes repayable on demand, and that will therefore cause long-term liabilities to be classified as short-term liabilities. Don't forget as well, and it's always a very unpopular point really with delegates on courses, that where the bank has waived the breach or regularised the breach in the post-year-end period before the accounts have been signed off, that is a non-adjusting post-balance sheet event. So I think the key thing there is you've got to look at the year-end position, and if that means the loan's got to be reclassified from long-term to short-term, detrimental though that might be to the company's balance sheet, that's very much the way you're going to have to go. Charity B, impairment adjustments. I think possibly, and I think certainly in the current climate, we are going to see for a whole lot of different sorts of entities, from the balance sheet under pressure in terms of things like impairment adjustments. What I'm always quite keen to mention, I think, in the context of charity SORP, and I've made this point a lot over the years, is that when the charity SORP thinks about impairments, given that charities are there to do public good rather than to actually generate income, it always frames impairment in the context of, is the service potential of an asset being lost? Where I think in a commercial entity, it's more about the value being used. Is the asset generating the money that it was before? So if an asset basically is not being used in the light of where we currently are, there may well be a loss of service potential. There may well therefore be an impairment issue. But actually that's a very different situation to what you're going to get in a commercial entity, where I think therefore impairment is more common than it is for charities. And the final one, charities seek out to lay some staff off and make redundancy payments before the accounts were signed. Should we provide? Well, potentially, the key thing to bear in mind here, and against a point that applies to non-charities and charities, is when you're going to make a provision for redundancy cost, there needs to be in place a demonstrable commitment to lay the people off and make those payments as of the year end. We get this very bizarre situation whereby you might perhaps lay people off post year end in the light of the current climate, really, I suppose. You may well, by the point the accounts have been signed, have actually made the relevant payments. You're therefore really clear what the payments were actually going to be before the point of sign off. But if you weren't demonstrably committed at the year end, you can't make provision. So it's quite a tough regime there, section 21 of FOS 102. And yeah, it applies to charities and non-charities. We've had lots of questions on that recently, and that's the way the rules work in that particular area. Okay, last thing to look at briefly is guidance for independent examiners. I wanted to just flag, if I could, some really good guidance which the various charity regulators have issued for independent examiners during the current climate. I won't go through all the detail, I'll just perhaps flag a few points. They're very much advocating that what you might do as an examiner in the current climate, where maybe it's difficult to get access to management, difficult to get access to accounting records, is to be creative, think about using technology, think about using things like screen sharing, do what you can to get over the line, really, in relation to getting your examination done. It also makes the point that perhaps for situations where you've been examiner for many years, you've got a good relationship with the client, maybe you've been providing accounting services over the years as well as providing examination services as a firm, more scope in that situation, I suppose, they're saying, to perhaps place reliance on verbal assurances provided by management, where in the situation where maybe the independent examination is quite new to you, need to be a bit more sceptical and a bit more on guard. The points about spending out with purposes and restricted funds is saying that in these difficult times, it may well be that in order to actually just keep afloat, what charities might do is spend money on things which their charitable constitution does not allow them to spend the money on, and linked to that, they might use restricted funds monies for different purposes. That clearly is not allowed, and what they're kind of doing in the guidance here is flagging that up as a risk and saying that if there are instances and evidence of that taking place, there'll be consequences then for the examiner and their reports. The point about controls is that in these difficult times, internal controls might be different, they might be more rudimentary, but you'll need a modicum of internal control to ensure that charity assets are appropriately safeguarded, and there's some good guidance on that. And the reporting point is quite simply that in these difficult times, with examination being difficult, there's an expectation that in some situations, the scope of examiners' work will be limited, and there will be a need to make reference to that in the examiner's report on occasions, as indeed there will be a need on occasions for examiners to flag up a material uncertainty that casts significant doubt on going concern. So good guidance, do have a look at it, and very helpful for examiners certainly in the current climate. Right, so takeaways from this short session today. There are broad reporting implications for charities where going concerns in doubt, not only in the accounts, but to regulators as well. We flagged that up in the early part of this short session. CJRS raises interesting questions about funds analysis, and I went through a few of those as they popped up on recent courses. There are significant accounting implications for March 20 year ends and beyond. We went through 2 or 3 of the more commonly asked questions there. And yes, do get your hands, if you are an examiner, on that. Very useful advice, very helpful, I think, at the current time when examinations clearly are quite difficult. Okay, I hope you find that session useful. A few sort of details here of other places to go for information. So do drop us a note at inquiries@insight-training.biz if, for example, you would like to get a copy of the slide deck that accompanies today's short session. Do have a look at our website, insight-train.biz, for information about our longer interactive seminars. And do check out onlinetutors.co.uk, some really good content there from Dean Wootton, all free, about some of the tax implications of what's going on in the current climate. A personal thank you from me as well to Richard Hemmings and James Charlton for their input on one or two of the technical issues I covered during today's short session. Do hope you find that useful and look forward to speaking to you again soon. Thank you and goodbye.